Hey, what's going on, family? Come with me for this conversation where I get to nerd out with Ortez, where we talk about mortgage rates and what is happening right now. Actually, I filmed it about a week and a half ago. What's happening right now, and if things stay consistent, what to expect moving forward into the year. So come on, check that conversation out. But remember, on March 16th, 2024, I'm conducting a homebuyer seminar with some team members of mine. This is an in-person event. The registration link is in the description below. Go ahead, check that out, and register if you want to come to the home buying seminar. Now let's get into the conversation where we get to nerd out about mortgage interest rates and how you can prepare yourself to buy a home or sell a home presently and moving forward into the year. Let's go. What's going on, family? Today, I have a special guest that wants to join the podcast, and I actually sought him out to talk about what to expect if interest rates stay elevated. In the fall of 2023, we saw interest rates in the sevens and get all the way up to the eights. And then they took a dip in December and January, and we saw a flood of people coming to the market. Well, now in February 2024, we see interest rates above 7 as an average. So as we go into the spring housing season, house buying season, I want to play out this hypothetical on what to do if interest rates stay elevated for buyers out there, so you know what to expect and can prepare accordingly as we head into this market. Now, I don't know what the interest rates are going to do. Nobody's a fortune teller, but if you're looking at just tea leaves and breadcrumbs, we've heard Jerome Powell say the Fed is not going to reduce the federal funds rate. So, and we're getting elevated inflation readings. So that's causing interest rates to go up. But let's bring Ortez to the screen so we can talk to him about what he believes will happen in the mortgage market. And I'll talk about the housing market if interest rates stay elevated. What's going on, Ortez?
What's going on, sir? How you doing today, brother?
I'm doing all right. So let's jump right into it. I got distracted by the hat. Your Lions, I noticed the Tigers, but congrats on the Lions season this past year.
We should have played you in the Super Bowl. It should have started. The season should have started and ended the same, but neither here nor there. I'll digress.
I'm with you. I want to pull up this article from Mortgage News Daily real quick, where it just talks about interest rates being high again. It says mortgage rates match the highest level since late November, and it talked about how interest rates have trickled down in December and January, but long-term interest rates are still elevated. So that's where we're getting our data from. It's not just me or you just spitballing it. This is actually happening in the market, and we've seen that mortgage purchase applications have decreased over the past couple of weeks because of the elevated interest rates being at or above 7%.
Yeah, this is so. Yep.
Now, as we head into the spring buying season, what do you think will happen hypothetically if mortgage rates stay where they're at right now? And just tell us what you're seeing presently too.
Well, I mean, as you had alluded to, like the mortgage application rate is down, but leading into the spring, what it's going to cause is probably a higher inventory. That if people position themselves well, it's going to be the pick of the litter in terms of buying season once the summer comes, right? So when you think about whether or not should I buy now, the question is, have you positioned yourself to buy at any time? Right. And that's always the plot, because the thing is, even though interest rates are elevated at the time, they're not going to stay that way. So being able to position yourself to purchase a home while you're able to purchase a home, it's easy to refinance a house. Like nobody, that you can look up the data. On average, every 5 to 7 years, two things happen with mortgages. Either the person refinances or they end up moving and getting out of the mortgage. Mm-hmm. So the biggest thing is, if you are in ability to buy a house and to get something that you like and enjoy, go ahead and, as you would say, get on the wheel, right? Just jump on the ride, get on the bandwagon.
Jump on the property ladder. Get on the property ladder while you
can, But the biggest thing, the key is making sure you position yourself to whereas once you get on that ladder, you can stay on that ladder, and then it only gets easier from there because refinancing isn't hard. I don't understand why it seems like that's a taboo word for folks when it comes to buying a home. They're like, oh, I don't ever want to refinance. Like, it's just like that's kind of part of the whole
part of the process, right?
part of the process, right?
Yeah. If rates go lower, you refinance, or even if rates don't get lower, if you get a certain amount of equity in your home and you need to pull it out for whether it be your kids' college tuition or whatever it may be, an unforeseen circumstance, health scare, you have that equity to be able to refinance and pull some money out. Now, when you say put yourself in proper position, what does that look like?
So obviously we can't control what Jerome Powell does. Right? We can't control what they do as far as like inflation, as far as interest rates and things of that nature. The things that we do have the power over is what we spend our money on. Yep. And those are our debts. So, I won't get too far down the rabbit hole, folks, but the fewer debts that you have, the more buying power you ultimately have when it comes to, I'm sure you heard this term debt to income ratio. I'm sure you've heard it thrown around a lot. It's another video. I've got videos on the YouTubes where it breaks down what your debt to income ratios are. But the lower your debts are, that means like there's more room that your actual money can be used to purchase a property. So people always say like, well, oh, I can't afford a certain dollar amount payment, right? Mm-hmm. Well, if we break down your situation and look at, let's say, the debts you're liable to, you may be paying a $900 auto loan. You may be paying $1,400 in credit cards a month. You may be paying, an installment debt or taking out, payday loans and things of that nature that are eating at your affordability. And by taming those back and controlling what you spend, basically stop being a consumer for a certain period of time. So that way, when you are ready to be a buyer of a home, it makes it a whole lot easier for you in that terms. And then, like I said, even though the payment may seem large at the beginning, you refinance that into a payment that's more manageable and down to where it is that you want it to be. But then you still have the house that you really enjoy, and you're not running around here saying, oh, the interest rates, or, oh, I can't find a home that I like. You've positioned yourself to where it's the money that you have available, you're able to maximize all of it that we can allow you to, right? Because there are certain limits we have as lenders as far as that debt to income ratio is. But the more you do on your end, the easier it is for us to approve you for those higher payments to then afford the house that you can then refinance into a lower payment. So it's all about
what I hear you saying is delayed gratification, meaning that thing you want to buy, put on a credit card, or the thing you want to buy right now and not put on the credit card bill to pay it down, delay that gratification so we can be in position to have those funds available for debt to income purposes when it looks good when you're applying for a mortgage. You're not saddled with that debt, new debt or old debt because you paid some off, right?
You literally, in layman's terms, exactly. Yeah. Exactly.
Perfect. So I'm with you on that. I want to take a quick look at what's happening in the Charlotte housing market, and I want to touch on a couple other housing markets, but mainly Charlotte. I have prepared Columbia, Raleigh, and Charleston. We may not get into all of those in this video, but I promise, go ahead, like this video, subscribe to the page, and I'll get in and dive into all of those housing markets so you can see what's happening. But right now, I have right here the Charlotte housing market, and this is for February 22nd. Today, 2024. Let me see if I can see this. Okay, I believe we can see it. I believe it's running properly. Now this is from Altos data. Now they don't look at sold prices. We're actually looking at real time, what's happening in the market as far as what's available and what just happened. Because of the inventory, we still see that it is a seller's market. There's just not a lot of inventory on the market to make it a buyer's market. And if you look here in real time, I like to look at this little snapshot right here. I don't know if I can zoom in. The real time breakdown on the right side where it says median list price. We see that the median list price went up in the past week, over
Wow.
almost $10,000. And
Wow.
now what that says to me, now this is list price. This isn't, um, sold prices. But in the Charlotte area, you're getting anywhere from, I think the most recent data said 96 to 98% of the list price in Charlotte. So what that's saying is owners are bringing their homes to the market. Sellers are coming to the market, but it's in the higher price homes, because in order for that to jump so dramatically in a week, it had to be a higher price home to scale or to move these numbers. And then the median price of new listing homes, again, this shows exactly what I was talking about. New listing homes that went on the market in the past week, you see a $50,000 difference, $49,000 difference with
So you're
just the
looking at
price of the
houses that
homes.
are like, 600,
Yeah,
700,000, shooting that up
coming to the
like that.
market.
Okay.
Exactly.
Mhm.
Yeah, you have to, because the average median price is right around four, right under four. The average price is around 430, 420. And so in order to change those numbers so drastically, it had to be in the sixes or above. But we still see that the average days on market, I don't really like looking at average days on market because it takes into account huge outliers. So I like
Mhm.
looking at median days on market. It's more representative of what's actually happening in the market. We see the median days on market actually went down in the past week, even with the higher interest rates, right? And the higher price homes coming on the market. And we see that, again, I just want to prepare everyone so they know exactly what's happening. Listings that had a price decrease actually decreased, even with the higher price homes coming to the market. With higher interest rates, we see that less homes took a price decrease. That's why I say you get about, sellers are getting 96 to 98% of their asking price. They're not lowering their price. Well, actually, you see 35% of homes are lowering their price, but that's less than it was even in the beginning of February.
Yeah. Okay.
Price
Yeah. Mhm.
increases, 7% of homes had a price increase. Relisted, you see 5%. Inventory is actually consistent for the past week, stayed steady. Median rent, now the median rent is weird because the median rent, they go off of like 2 bedrooms, and I'm not sure how many families want 2 bedrooms, but that's what it is, $1,900,
Mhm. Okay.
almost $2,000. Um, Market activity, still a strong sellers market. So I show all that to come down to this right here, because in my opinion, if interest rates stay elevated in certain price points, I say the above 530 for this right here, this example, the days on market will increase because there'll be less amount of people that can afford, because of their debt to income. They may make enough money, but because of the debt income ratio, there'll be less people that can afford these higher price homes. So you'll have them stay on the market for longer. And if homes stay on the market longer in that higher price point, that means the inventory will build. And if inventory builds, that allows those of you who, like you said, Ortez, that put themselves in position to come April, come May, to capitalize on this larger inventory because days on market have increased, and get an offer that's accepted where you might get some seller concessions. You might be able to offer, not significantly, but what, 10, 20, $25,000 less than the asking price. And then we can talk, let's say, talk to your realtor, go to Ortez. Mortgage broker, go to Ortez, or a realtor myself. And what's the best structure for that? Is it better to just offer less for the property, or is it better to ask for more concessions if that means buying down the rate and paying closing costs to where it's less money out of pocket up front? But that's a conversation, an individual conversation you need to have. Um, but this $400,000 or less, the 396, Yes, I still think that inventory will rise, but not as dramatically because most people can, let me stop sharing. Most people play in that ballpark because the median price home in the Charlotte area is right. Well, average is what 435, median is 390, 389, something around there. So everything is right there. That's where most of the buyers are. So you still have a larger population competing for those properties. If interest rates are high going into the spring buying season and the summer buying season, what do you think will happen come fall or August, like when school ends, school people go into school time, most buyers put their buying on hold because they've already got their kids in school. I'm just trying to get ahead of the. Again, this is a hypothetical, right? I'm just
Mm-hmm.
trying to get ahead of the curve to where, okay, if interest rates are high, less people can afford because they didn't plan properly or prepare themselves. What do you think will happen as we go further into the year?
It'll probably be just a lot of houses sitting, and
Mm-hmm.
and if that's the case, then I'm not saying it's going to be a drastic, but the prices might either flatline
Yep.
or take a slight decrease because something has to give. Because we're in a market where if a seller has to sell, they have to sell, and they'll do anything to make it sell, right?
And they have to
So
make it
it's
appealing,
like,
right? They
yeah,
they
exactly.
they may they may see like, hey, 30 days average days on market, but if it's been 60, they're like, no, we gotta
No,
do something
look,
here.
and especially if
Yeah.
because we see this often, if the seller is either has to move in a hurry,
Yep.
due to job relocation, or they have to, they're actually purchasing a new property for
Yes.
whatever reason, upgrade, downgrade, and
Hmm.
they're needing the funds from this sale to fund the next purchase,
Yes.
So if you have those situations, like I said, one or two things is going to happen. Either the inventory is going to build so much to where it'll then flip to a buyer's market. But then if it flips to a buyer's market, then they dictate the prices that they're willing to pay,
Yeah.
right?
And
So
now I'm
like,
about to throw another wrench in there.
okay.
Again, this is a hypothetical situation,
Mm-hmm.
but just based on data and everything like that, I think I don't think the Fed is going to cut. Federal Jerome Powell said he's not going to cut until he sees he broke something, right? Like something serious in the economy. So I think that will be around the fall time. So let's just say interest rates or the federal funds rates are cut at that time, and then interest rates come down. What impact do you see that having on the housing market? Even though there's the inventory built up over the spring and summer, right? Interest rates stayed around 7, but now they've come down because the federal funds rate has been decreased. What impact do you see that happening on the housing market?
Well, it could open up the floodgates.
Yeah.
Like it could to where it's like, that always almost be like if the levee broke.
Yeah.
You'll have all these buyers that are sitting right there on the edge that are just waiting for, like, they may be ready. It may be like,
Mm-hmm.
and if you're a smart buyer, if there's a certain, like, let's say there's a neighborhood you want to be in, or like a certain price point that you're wanting to be in, and you're right there, like, right now I'm looking at like a 450, but like if it drops like a quarter of a percent, I could be like at that 475 point,
Yep.
and then I can get into this better school district and this better neighborhood that I want for my kids. Obviously, it's like whatever the motivation is for the buyer, it's theirs. But if that were to happen, then that would open up the floodgates into the market that you show where, over that certain price point, the inventory may build up. Then you
Yes.
may see that inventory go, slash in half, because now that
More
interest
people
rate
can
led
afford it and get
price
in there.
point. Yep.
Yep.
So now they can get in there. So if it were to, like, and mind you, it wouldn't have, and the thing is, it wouldn't have to like slash like dramatically. Like
No.
the power of like a quarter or 0.5% is huge, especially with the interest rates being as high as they are. So it's not like they have to drop from, like, let's say, an 8 to a 6.5, right? In order for you to like get to that next price point. You know what I'm saying? Especially if, as I said before, the buyer put themselves in a position to where is, debt to income wise, and financially, they could do that, right? They could support that larger payment. But once the interest rates do fall, you're, especially in the fall, like the only thing I can see that it may not be an all out blitz is the schooling.
Yes.
So you know how important it is for uprooting kids from schools, especially, you know, you've got two young ones, I've got two young ones, they've got friends, they've got teachers they like, things of that nature. So uprooting them in the middle of a school year may be a little tough pill to swallow, but if it's to the point where you're getting to where you want to be as far as a buyer, as far as location, as far as proximity to things that you like, things that you enjoy, because ultimately that's what a house is. It's just a domicile closer to the places you like to go, right? So you're looking at, if that were to happen, a slight influx in the fall, just depending on if how flexible you are with like anybody who's in school, like for the like family dynamic. But if it's like a, you know, a single person or a newly married couple, it might be like their playground. They, you know what I'm saying? Like, you know, like, hey, we can move and shake and go anywhere we want to at the drop of a dime, just so long as it's close to work, our friends, things of that nature. Yeah, it'll probably open up a whole new area for them to purchase it.
Yep. And I mean, just put it in real terms. I have a lot of clients that move here from California, LA, New York, and they are perfectly fine because they do it now. They're like, okay, now we've uprooted our kids in the middle of the school year. That means I have to drive them to school. Well, hell, I do that right now where I am, well, I did that before when I was in New York and I was in California. That was just part of our morning routine. I would drive them to school. So they would gladly be able to move to that location that they want to be in, that neighborhood, and still yet, if they had to, drive their kid to school for the remainder of the school year or the remainder of that semester.
Yeah.
Yeah. Okay. And last thing I want to touch on with this is I was trying to pull it up when you were talking. I could not find it, but I was talking about how millennials are not just entering in the home buying age, and
They're
they have,
dominating right now.
yeah, but things are turning to where just even what 6 to 9 months ago, millennials were adverse to the housing market. They're like, no, we will hold off. But they recently did a study this past week, and it said 55% of millennials are actually going to buy in the next year or two, where they're more apt to do it. Because, but if you just would have, again, they did poll them just last year, and everybody was like, no, no, no. But once that biological clock starts ticking and you realize, one, you know, you want to have a family, you want to have kids, you're like, oh no, the housing market, it is what it is. Interest rates, it was in the sevens last year, 8% kind of broke things. Well, okay, it's right around 7 now. It just is what it is. And they're educated enough to where, like, okay, if I need to refinance, I'll refinance. That will be a huge determining factor as far as if inventory, in my opinion, will sit on the market. If they're going to be okay and accepting of just this is the new normal, or are they going to be like, no, we need to wait till they get to the low sixes or high fives, which may be a while. And even if it is a while, I think I did pull up one article. Where is it at? That's not it. Hold on. Yeah, even if it is a while, I talked about how home ownership is becoming more diverse. In the study, now talks about millennials. The article of this is how millennials are shifting the housing market. Is the title of this article, and based on a report released on February 13th, it said over the next 5 years, 1.5 million Black households are expected to turn the median home buying age. 775 Asian households and 2.2 million Hispanic households are turning the median home buying age. So millennials and Gen Z will have a huge factor in what's happening in this housing market. Now, yes, the baby boomers are aging in place. They're not bringing their homes to the market, and they're keeping those large homes. But I understand their process. As we talked about earlier, your home is like a piggy bank at a certain point. Those baby boomers got their home, probably refinance to a 2-3% interest rate, and they
They're
have a ton
sitting
of
put.
equity and sitting put, a ton of equity to where they may not have that 401k. They may not have that retirement account or that brokerage account, but they do have? They bought a
That
house.
house.
They bought a house, and they're sitting on that house, where most baby boomers that I've talked to that I go list their homes or have a conversation with, they're sitting on at least $300,000-$400,000 worth of equity. So they
Easily.
have that to just live on and live off of until they ride into the sunset. Now, even though the home may not be conducive to their needs, right? Even though the home may have an owner's suite that's upstairs and they would like one downstairs, but they're like, why would I do that? When I can sleep in the guest suite downstairs or something like that, because they're sitting on so much money.
Yeah. Or in the rocking chair, whichever is closest.
Wherever it is.
Wherever it is.
Ortez, how can people contact you?
Yes. So you can reach me via phone 517-881-8352 or via email at ortezf@mortgage-partners.com. That's ORTEZ, the letter F, at mortgage-partners.com. Here in Charlotte, North Carolina, with Affordable Mortgage Partners, executive loan officer and part owner of the brokerage, setting up shop here in North Carolina. So
now, you say North Carolina, but you service North Carolina, South Carolina. You all service a myriad of states.
Yeah, so we,
because I'm right on the border here. I live in South Carolina. I'm right on the border.
So North South Carolina, we service Florida, Colorado, Texas, Ohio, Michigan, and then am I forgetting anybody else? 3, 4, 5, 6, 7. No, those are the 7 states we got. So we're currently in those 7 states, looking to expand. Hopefully we might go a little bit west to that Peach State. But we'll see what we got going on after that. But yeah, you can reach out to me, go ahead and get a pre-approval, so then I can go ahead and flip you over to Sir Ashley. We can get you in one of these beautiful houses down here in the Carolinas.
Perfect. No, thank you very much. I appreciate y'all rocking with us. And my contact information will be in the description below. info@sirashley.com is probably the best way to get a hold of me. Again, I appreciate you. We'll talk to you next time.
See you.